This data captures average franchise values across major North American sports leagues between 1991 and 2022. Look at the average annual growth rate on the right, pushing the NFL and NBA into multi-billion-dollar territories. To put that scale into perspective, Forbes calculated the Dallas Cowboys at an $8 billion valuation. For a fan, the scoreboard dictates success. You tally wins, losses, and playoff runs. But for an ownership group, success is measured through the lens of financial management. Take the Golden State Warriors. They built a powerhouse on the court, securing 3 championships in a single facility. Yet despite a waiting list of 40,000 fans, they eventually hit a financial ceiling at their old arena in Oakland. In the current era of professional sports, titles alone do not sustain a franchise. Longevity requires a sophisticated corporate strategy to manage the sheer magnitude of the industry's economics. That pressure led the Warriors' ownership to a massive private gamble. They left their longtime home in Oakland to finance a brand new $1 billion arena in the heart of San Francisco. To the average observer, a $1 billion private stadium sounds like a move that could easily bankrupt a team. Understanding how a team survives a risk of this scale requires a look at 2 specific documents, the income statement and the balance sheet. The income statement is a financial document that tracks an organization's financial activity over a specific window of time, like a single fiscal year. It tracks revenues, money coming in from tickets and sponsorships, against expenses, like player salaries and insurance. The remaining balance is the profit. In Oakland, the Warriors' revenue was limited. Their lease required them to share a portion of their premium seating, parking, and concessions with the local city-county authority, while their old facility offered few opportunities for expansion. The move to the Chase Center changed those numbers. By owning the facility, the team could command suite prices up to $2.5 million, 10 times what they charged in Oakland. With the addition of a $300 million naming rights deal, the team's annual revenue potential shifted significantly upward. Ultimately, the new arena was a calculated strategy to increase the top line of their income statement permanently. While the income statement tracks a period of time, the balance sheet is a snapshot of total financial health at one exact moment. One side lists assets, anything the team owns that can generate future revenue. The Chase Center is a massive asset, but how does a team account for a $1 billion structure on their books? They balance it with liabilities and owner's equity. Liabilities represent borrowed money, like construction bonds, while owner's equity is the owner's own capital. On the balance sheet, the value of that debt and equity must perfectly match the value of the asset. While the stadium is an asset, it also puts immense liabilities on the books. Managing that debt is a constant requirement to avoid the risk of default. Ownership justifies this level of debt by calculating the return on investment, or ROI. This is the expected dollar value return, expressed as a percentage of the project's original cost. To achieve a positive ROI and break even, the arena must remain active. It needs to book over 200 events every single year to cover its costs. Every concert and ticket sold is a mathematical requirement to pay down the interest and principal on the debt. Every business decision in sport is tied to this inherent risk. The Warriors' case demonstrates that professional sports franchises operate as complex financial portfolios, managing massive levels of risk alongside their on-field performance. Whether it's an NBA dynasty or a local fitness club, the foundational rules of finance remain the same. You must generate funds, allocate them with precision, and carefully balance your risk against your potential reward. The next time a new stadium opens or a record-breaking contract is signed, look past the jerseys. In a world of billion-dollar assets and 9-figure salaries, the final score on the board is only half the story. The other half is written in the ledger that made it possible.